to another video, and as always, if you are new to the channel, a sub would be really appreciated, as I do provide valuable educational content on a daily basis. And if you enjoy the video, please smash that like button, and as always, let me know down in the comments below exactly what it is that you would like for me to cover in the next video. So today we're going to look at the S&P 500 from a sentiment, technical and order flow perspective, and look for the best possibility or probability moving forward. Now, starting on the monthly time frame, we can see how the S&P 500 had broken above this level of resistance, and once resistance gets broken, it becomes support. And we can see how the market tested that level and rejected it quite aggressively. Now, taking our Fibonacci here from the low to the high, we can see how the market had hit the 50%, which is a 50% retracement of this candle that we had over there, and the market just skyrocketed from there. Now, in order for us to measure this next impulse to see if it had come to an end, we basically now need to drag our fib there from the low all the way to that low over there. Now we can see how the market had hit the minus 27, which is the first pullback level in the market. So there's definitely a pullback expected from where the market is now. Now on the weekly time frame, the market now printed this overextended W formation, and by definition, when the market prints an overextended W formation, you can always expect the market to pull back to the left leg before continuing higher. Now on the daily time frame, we can see how the market printed this massive impulse, and after an impulse, you obviously expect a correction, and the way you measure that correction is by taking your Fibonacci from the low to the high of the impulse. Now we can see how the 0.382 is lining up perfectly with the structure, or perfectly with the level of resistance that got broken that is now turned support. Now looking at the order flow data, so what the big banks, hedge funds and institutions are doing in the market. Now we can see based off the last report how hedge funds closed minus 5.4k longs, and they added plus 864 short positions. So you can look at this as buy positions, so they closed over 5k buys and they started adding some selling positions as well. So there's another reason for why we can expect this market to dip low first before continuing higher if the data proves that it needs to go higher from here. Now looking at the sentiment data. Now the sentiment data tells us what the retail traders are doing in the market, and we can see how 58% of retail traders are currently buying the S&P 500, as to where we've got 41.89% of retail traders selling the market. Now we obviously want to be on the opposite side of what most retail traders are doing, so looking for a sell on over here I think is probably one of the best things that we can do. Now the best way to approach the situation from where we are now is, because we can see the market is quite bullish because we have all of these green candles. I can see how the market is starting to show signs of deceleration over here, because you can see how these candles are starting to get more exhausting, more exhausted as well. And then what you need to do is you obviously need to wait for the momentum of the market to shift, because we can see we're quite bullish. So wait for the market momentum to shift, to a more bearish side, because we're looking for sells, and then start looking for a valid entry, maybe from a lower time frame. And if you can refer back to the the previous video I've done in terms of how to look for an entry based off market structure as well. Now if you enjoyed the video, as always, smash that like button for the YouTube algorithm, and as always, thank you so much for your time, and from my side, cheers for ears.